Ladies and gentlemen, pay close attention because what is happening right now in the global silver market is not a minor fluctuation, not a seasonal disruption, and certainly not a routine correction. What we are witnessing is the early stage of a structural breakdown, one that is exposing the fragility of the financial system and the vulnerability of physical precious metal supply chains. For months, pressure has been building beneath the surface. Central banks have been tightening and loosening policy at a pace the world has never seen. Nations are weaponizing currencies. Global alliances are shifting and inflation remains far from under control. All of this has formed the perfect backdrop for a critical moment in the silver market, a moment that is now impossible to ignore. Today, multiple silver dealers around the world are quietly closing their doors, halting sales or restricting orders, and they're not doing this out of caution, they're doing it out of necessity. Supply is thinning, premiums are rising, and institutional players are quietly moving in, absorbing physical silver faster than the market can replace it. When retail buyers show up today, they're being met with two words: out of stock. The first and most alarming sign that something serious is unfolding in the silver market is the sudden and widespread shutdown of dealers around the world. This is not a rumor, not speculation, and not a dramatized headline created for effect. It is a real observable phenomenon. Silver dealers, companies that for decades have prided themselves on being the last stable bridge between paper promises and physical metal, are now closing their doors, restricting orders, or posting unexpected out-of-stock notices across their websites. To understand the magnitude of this moment, you must recognize how rare it is for this industry to halt operations. Dealers function in an environment where constant availability is part of their identity. Their entire business model depends on being able to reliably supply physical metal to investors at any time. For them to shut down operations, even temporarily, signals that something deeper is taking place beneath the surface. These shutdowns aren't the result of minor supply delays, shipping backlogs, or holiday season inventory cycles. What's happening is a direct reflection of overwhelming demand colliding with dangerously thin supply. Dealers can only sell what they physically have. And once their vaults start emptying, they face a difficult choice: continue selling and risk running out completely, or close the doors until restocking becomes possible again. The fact that so many are choosing the second option reveals just how severe the supply situation has become. In many cases, the moment inventory arrives, it is bought out instantly, sometimes by a single institutional order large enough to wipe out an entire batch in minutes. Retail buyers who are used to browsing various weights, brands, and mint varieties are now confronted with empty pages and notices that tell them to check back later. Another crucial detail is how quietly these closures are happening. Dealers are not putting out lengthy announcements or ringing alarm bells in public. Instead, they are simply turning off ordering systems, limiting purchases, or marking items unavailable. This quiet approach is intentional. The industry understands that openly declaring a shortage could create a panic, one that would accelerate the very problem they're struggling to control. Yet, even without dramatic announcements, the silence speaks louder than words. When one dealer faces shortages, it may seem like a temporary issue. When dozens do across multiple continents, it becomes impossible to ignore. The root of the problem is not merely high demand, but a structural imbalance that has been building for years. Mining output has struggled to keep pace with industrial needs, and recycling does not provide enough to fill the gap. At the same time, economic tensions, inflation, and geopolitical instability have pushed more investors toward physical metals. When people lose trust in financial institutions or the direction of markets, they naturally turn toward assets with intrinsic value. Silver, being both an industrial necessity and a historical store of wealth, becomes a prime target. This dual role is what makes silver uniquely vulnerable in crisis periods. Industrial users cannot pause their operations, and investors cannot afford to wait for stability. Both groups pull from the same limited supply, creating a tug of war that strains the physical market. When dealers shut their doors, it is more than just an inconvenience. It is a warning. It signals that the physical market is entering a phase where demand overwhelms availability, where premiums rise sharply, and where the window for easy access to silver begins to close. The significance of this moment should not be underestimated. Once dealer shutdowns begin, the next stages often unfold quickly tightening supply, rapid price movements, delays in delivery, and increased restrictions. What may look like a temporary pause is often the first visible symptom of a much larger disruption. The second major sign that the world is entering a dangerous phase is the unmistakable shift in global financial markets. These markets are not simply fluctuating, they are moving into crisis mode. Anyone who watches the signals carefully can see the pattern forming. Stress is building across multiple sectors at the same time. And history shows that when these indicators line up together, the system is entering a period of instability that cannot be ignored. It begins quietly with small movements in bond yields, subtle shifts in credit markets, and changes in banking behavior. But those small movements add up, forming a picture that reveals far more than the average analyst is willing to admit. Bond markets, often called the nervous system of the global economy, are flashing warnings. When government and corporate debt becomes unstable, everything else begins to shake. Yields rising too quickly indicate fear, uncertainty, and declining confidence in the ability of nations or companies to manage their debt loads. Yields falling too sharply indicate fear of recession and a flight to safety. The problem now is that markets are oscillating between these extremes, unable to find balance. This instability suggests that investors are no longer clear about the economic direction ahead, and uncertainty on this level almost always precedes major disruptions. Banks are responding to these stresses in ways that may not be obvious to the public, but are extremely visible to those paying attention. Lending standards are tightening, credit is becoming harder to access, and institutions are quietly reducing risk exposure. When banks pull back, it is not because they want to slow economic activity. It is because they are preparing for something. Liquidity begins to shrink, loan approvals decline, and businesses start feeling the pressure. These early steps are what banks take before financial turbulence becomes unavoidable. Major economies, too, are showing signs of strain. Many countries have pushed their debt levels to historic highs, levels that are mathematically impossible to resolve without either inflation, currency devaluation, or painful economic restructuring. None of these outcomes are benign. Inflation erodes purchasing power and confidence. Currency devaluation disrupts global trade and drives capital flight. Restructuring leads to recessionary forces, job losses, and market contraction. The world now sits in a position where multiple large economies are facing similar pressures at the same time. This is not isolated instability. It is systemic. In periods like this, investors, corporations, and even governments begin searching for assets that offer safety. Stocks become risky. Bonds become questionable, and fiat currencies lose reliability. Historically, during such moments, capital begins moving into tangible assets, real resources, commodities, and precious metals. This is why the crisis mode behavior of global markets is directly connected to the tightening in the silver market. When financial systems show stress, the demand for physical assets increases sharply. But unlike digital assets or financial instruments, physical metals have limits. There is only so much available at any given moment. What makes the present situation particularly concerning is that these signs are emerging simultaneously. While geopolitical tensions are also rising, conflicts, trade disputes, and energy and security add fuel to an already unstable environment. Markets thrive on predictability, but right now, predictability is vanishing. Investors are being forced to react rather than plan, and reactive markets often swing violently. When global markets enter crisis mode, the consequences spread quickly. Volatility rises, liquidity tightens, and confidence erodes. These are not abstract concepts. They directly impact the availability of essential resources like silver. Financial instability pushes more people toward physical metals, increasing demand precisely when supply chains are most fragile. The result is a feedback loop where financial stress amplifies metal shortages, and metal shortages further reveal the fragility of the financial system. The situation unfolding now is not a temporary disruption. It is a sign that global markets are transitioning into a period of heightened risk and instability. The signals are clear for those who are willing to see them. The third and most revealing aspect of unfolding situation is the unmistakable drying up of physical silver supply. This is not a minor imbalance or a temporary inconvenience. What is happening right now is the exposure of a long-standing structural weakness that the market has managed to hide for years. While the digital and paper versions of silver, such as ETFs, futures contracts, and derivatives, can be created in practically unlimited quantities, physical silver cannot. It either exists or it doesn't. And today the reality is simple. There is not enough physical silver available to meet global demand. In normal market cycles, dealers maintain large inventories to ensure consistent availability. Wholesalers distribute metal to retailers. Mints produce new rounds and bars, and miners feed the entire system through continuous extraction. But when a shock hits the financial system, everything changes at once. Investors who previously ignored silver suddenly rush toward it. Industrial buyers accelerate purchasing to secure materials, and mining output becomes insufficient to meet the surge. The result is a sudden tightening that cascades through the entire supply chain. One of the primary drivers behind the current shortage is the imbalance between production and consumption. Silver mining has been declining in several major regions due to rising operational costs, regulatory constraints, and/or depletion. Mines that once produced abundant silver now yield less, and new mining projects take many years to bring into operation. At the same time, industrial demand has been rising at an extraordinary rate. Silver is not just a financial asset. It is an essential component in solar panels, electric vehicles, medical technology, artificial intelligence, hardware, telecommunications, and countless modern electronic devices. These industries cannot slow their consumption simply because supply becomes tight. Their production lines depend on it. And without silver, entire sectors would grind to a halt. Industrial users, unlike investors, purchase silver in bulk. When they detect stress in the supply chain, they move quickly to secure long-term contracts and stockpile reserves. This drains available inventory far faster than the retail investment community realizes. While individual buyers might be trying to purchase a few ounces or a couple of bars, industrial players move thousands of ounces at a time. When they act, market shifts instantly. Another major factor is the dangerous disconnect between paper markets and physical availability. Paper markets create the illusion of abundance by allowing multiple claims on the same ounce. As long as people do not attempt to convert the dues of paper positions into physical metal, the illusion holds. But when economic uncertainty rises and investors begin demanding actual physical silver rather than digital representations, the system comes under immediate pressure. Suddenly, promises must be backed by real metal, metal that often does not exist in sufficient quantities. This is exactly what is happening now. The demand for physical delivery is spiking at the same time that the available supply is shrinking. Dealers cannot replenish fast enough. Wholesalers have reduced stock, and mints are facing delays in sourcing raw material. Refiners face bottlenecks. Miners cannot accelerate output quickly, and the entire supply chain becomes strained from end to. And for the everyday buyer, this tightening appears as outstock notices, rising premiums, delayed deliveries, and limited order quantities. These signs might seem mild on the surface, but they are the first visible symptoms of a deeper structural problem. When the physical market becomes stressed, it does not resolve quickly. It often leads to prolonged shortages, elevated premiums, and a widening gap between paper pricing and real-world pricing. The drying up of physical silver supply is not a temporary event. It is the manifestation of long-term structural weaknesses colliding with sudden, intense demand. It reveals that the market is far less available metal than most people believe, and it suggests that future disruptions could be even more severe if current trends continue. Another critical element in this unfolding situation is the quiet yet powerful accumulation of physical silver by large institutional players. This activity is not being broadcast on financial news channels, and it is not something most retail investors notice until it is too late. Institutions prefer to move silently, and when they decide to accumulate physical assets, they do so with a level of speed and scale that far exceeds what the average buyer can imagine. Their actions rarely appear dramatic on the surface, but the impact is massive. What looks like a minor shift in market dynamics from the outside is often the result of enormous purchases taking place behind the scenes. Institutions operate with a very different mindset compared to retail investors. They do not wait for perfect conditions or ideal prices. They act strategically, often anticipating disruptions before they become obvious. When they identify vulnerabilities in the financial system or see rising tension in global markets, they move to secure assets that cannot be diluted or easily replaced. Silver, especially in physical form, becomes extremely attractive. In such periods, institutions understand that when confidence breaks in traditional financial instruments, physical resources become a foundation of stability. This is why during the early stages of financial stress, institutions begin positioning themselves long before the general public recognizes the risks. The scale at which institutions accumulate silver creates immediate pressure on supply chains. A single institutional order can wipe out the entire inventory of a dealer that typically serves thousands of retail customers. These purchases are often conducted through private channels directly from wholesalers, refiners, or even mining companies. They do not need to browse websites or wait for inventory updates. They negotiate directly with suppliers and secure contracts that lock in large quantities of metal over extended periods. Retail investors, meanwhile, are left competing for whatever remains after these major players have already acted. One of the reasons institutional accumulation is so disruptive is that it happens quietly but consistently. A retail buyer may purchase 100 ounces over several months. An institution may purchase hundreds of thousands of ounces in a single week. When this happens across multiple institutions, all responding to the same economic uncertainties, the market experiences sudden and severe tightening. This tightening is rarely acknowledged publicly because institutions benefit when the broader market remains unaware. As long as the majority of people believe silver is easily available, institutions can continue accumulating without triggering panic or significant price spikes. In addition to financial institutions, industrial corporations also participate in this silent accumulation. Companies dependent on silver for manufacturing cannot afford supply disruptions. When they recognize early signs of strain, whether through delayed shipments, rising premiums, or geopolitical instability, they start building strategic reserves. These reserves ensure uninterrupted production, but they also pull large volumes of silver out of circulation. Since industrial users buy in bulk, their strategic stockpiling accelerates shortages even more dramatically. This dynamic is further intensified by central banks and sovereign wealth funds, which have been increasingly shifting toward tangible assets. While their public statements often focus on gold, their private actions sometimes extend into broader categories, including silver. These entities have the capital, influence, and access to acquire enormous quantities without alerting the public. By the time retail investors see signs of tightening, much of the available metal has already been spoken for. The most significant part of this institutional accumulation is its subtlety. There are no dramatic announcements, no press releases, and no warnings. Instead, the public sees rising premiums, fewer products, increased order limits, and delayed restocking, all consequences of large players quietly draining supply. As institutions secure more metal, the availability for everyday buyers diminishes rapidly. This gradual disappearance of inventory creates the illusion that silver demand is steady, when in reality the largest players are absorbing the majority of physical supply. The quiet accumulation by institutions is a powerful indicator of what they anticipate. When those who understand market structure better than anyone else rush toward physical silver, it signals that deeper disruptions may be approaching. Their actions are not driven by speculation, they are driven by preparation. Another essential factor driving the current silver situation is the extraordinary surge in industrial demand, a force that has been quietly intensifying for years but is now reaching a breaking point. Silver is not just an investment metal, nor is it a simple commodity that fluctuates with market sentiment. It is a critical component of modern technology, energy systems, and medical infrastructure. Every year, industries consume more silver than the year before, and this consumption is non-negotiable. Unlike investors who can choose to wait for better prices or pause their purchases, industries must secure silver to continue operating. Without it, production stops, supply chains break, entire sectors of the economy risk collapse. One of the largest consumers of silver today is the solar industry. Modern solar panels rely heavily on silver paste for conductivity, and as countries accelerate their transition toward renewable energy, demand for solar technology has skyrocketed. Governments around the world are offering subsidies Energy companies are expanding capacity and private individuals are installing rooftop systems at record rates. Every panel produced requires silver, and unlike other metals, there is no easy substitute that offers the same efficiency. As a result, the solar industry is consuming hundreds of millions of ounces of silver every year. And this figure continues to rise. Even minor increases in solar manufacturing can create enormous pressure on global silver supply. Another rapidly expanding sector is electronics. Silver is the most conductive metal on Earth, which makes it indispensable in smartphones, computers, electric vehicles, 5G infrastructure, and emerging technologies such as artificial intelligence hardware. Every device that relies on high-speed processing or energy efficiency requires silver in some capacity. As technology becomes more advanced and interconnected, the amount of silver embedded in the global electronics ecosystem increases dramatically. Once this silver is used, much of it becomes virtually impossible to recover economically. It sits inside millions of devices until they are discarded, meaning the market continuously loses vast amounts of silver that will likely never return. Medical technology is another major driver of demand. Silver is used in antibacterial coatings, sterilization equipment, wound dressings, advanced medical devices. Its unique properties cannot be replicated by other materials, making it essential for hospitals and healthcare manufacturers. During periods of global health uncertainty, demand in this sector tends to surge even further as populations grow and healthcare infrastructure expands. The medical sector consumes increasingly large volumes of silver each year. Electric vehicles and the broader shift toward electrification also play a major role. Modern EVs require significantly more silver than traditional vehicles due to their advanced electrical systems, battery components, and onboard computers. As automakers race to meet emissions targets, consumer preferences shift toward electric mobility. Silver demand from this industry alone is expected to multiply. Charging stations, grid upgrades, and energy storage systems further amplify this trend. These industrial forces combined reveal a critical truth. Industrial demand for silver is not only rising, it is accelerating. Industries depend on silver to maintain production. They will always outbid retail investors. When supply becomes tight, this dynamic creates a dangerous situation for the broader market. When industrial users sense shortages or disruptions, they begin stockpiling. Their purchases are massive and immediate, draining available inventory long before retail buyers even notice a shift. What makes the surge in industrial demand especially threatening is that mining output cannot keep up. Silver is rarely mined on its own. It is typically a byproduct of mining other metals like copper, zinc, and lead. This means production is heavily tied to the economics of other industries rather than the demand for silver itself. Even when silver prices rise, mining cannot simply increase output quickly to meet demand. New mining projects require years of exploration, permitting development, and investment. Meanwhile, industrial sectors consume silver relentlessly regardless of price or scarcity.